In this video, you'll be learning about this topic. So guys, we have listeners with just different backgrounds in their personal net worth. We have many listeners who manage more than $1 million and even a significant share with even more than 10 million in the stock market. They might not have too much time to conduct real estate research, but they would like to allocate a part of their portfolio away from the stock market. So what would be your recommendation for people like that?
I would say, so the benefit of investing in stocks, at least from my opinion, because we get this whole stocks versus real estate conversation all the time. Real estate is going to be more labor intensive. It's going to be a slower way to build wealth. It's more like planting a tree and you wait, and maybe 5 or 10 years later, that tree starts to produce fruit. 15, 20 years later, it's producing a lot of fruit. And 20, 30 years later, you could literally cut that tree down and plant a bunch more trees with the equity that you've built. Stocks is a much quicker, if you invest correctly, you can build wealth faster. And there's less labor that you can do yourself to affect the outcome. With real estate, there's a lot you can do specifically to add value to your investment. Stocks, you're not in control. So what I find is people that appreciate stock investing, they don't want to do a lot of work. Maybe the work's on the research that they do for the company, but they like pushing a button, buying the stock, they're done. Then they see how it goes. Real estate investors tend to be someone that wants to be a little more hands-on. So the first part of this question that you asked, how do you invest if you're used to doing stocks, you want to diversify into real estate? You probably don't want something that's hands-on, because if you enjoy stocks, what you enjoy is picking the horse you think is going to win that race and betting on it and doing your research. That's the work you do. It's not managing a contractor and researching rents and looking through contracts to find out how you can adjust your lease. People aren't going to like that. So if you're into stocks, what I would recommend is you go find a general partner and invest in either their fund or their syndication, because the process will feel very similar to picking a stock. You're going to go choose the partner, which is like choosing the company. You're going to look at their track record. You're going to look at their investment plan. What type of properties are they going to buy? What is the income based on? And then you're going to bet on that person and put your deal or your money into that person's plan. It's very similar to stock investing, and it's also hands off. You do nothing. Once you've invested the money, they're doing all the work.
I like to call that strategy the earn, learn, and turn strategy. You earn your money doing what you do best. Like a lot of people think they got to jump into real estate and then go like flip houses or whatever, like, buy them, fix them up and sell them like you see on TV. I mean, it's a great way to make money, but most people who have money, like for example, you're a banker, you're a lawyer, you're a doctor, you're an athlete, you're a whatever, a finance person. You make really probably good money at your job. Your best thing, I think, is to earn money doing what you already do really well. And then you learn about the type of investing you want to get into. So like if you want to, I'll come back to that one. And then you turn your money over to somebody else and somebody you trust. So the learn thing is important though. You can't just give your money to anybody. So you got to learn about the type of investing you feel like you got some fire after you. And then you got to learn about the investor that you're going to invest with. You just don't want to throw money at some random thing, because it is riskier than, for example, throwing your money with Apple. I mean, we can all kind of trust that Apple is not going to suddenly run off to Mexico with your money, because there's a lot of people and there's a board of directors and they have a lot of laws and rules that govern what they do. But if you give your money to me and my fund, like you have to trust me that I'm not going to run off to Mexico. Now, there are safeguards in place. Like there are things like legally I'm not going to run off to Mexico, but you've got to trust. You've got to build that trust first. You got to understand like that, it's a lot smaller organization. There could be a higher increased chance of shady operators and just bad people out there. So anyway, you earn your money, you learn about the investment and the investor, and then you turn your money over to somebody else. I think that's a good strategy for people who don't want to be actively involved in real estate, but still want to play in the game.
It's interesting you would say that. Let's say that I'm even lazier than that. I don't even want to go out and find a partner, perhaps. Like, I'm that lazy. One of the main objections we hear from the audience here, whenever we talk about stock investing, is that they don't feel they have enough time to do any type of analysis. They make a good income, like you mentioned before, Brandon. There might be a lawyer or doctor or whatnot, but to them, it's hard to like figure out what should I invest in. Might be interesting, but they just don't want to lose money. I guess that's the first thing that we hear. But by the way, we should also grow that money we set aside, and also we don't want to spend too much time on it, right? So it is a tall order. And so for those guys, we typically say, well, buy a low-cost ETF, a stock ETF. Buy a Vanguard. It might grow, 8% a year or whatever that might be. It's not going to be super, super exciting, but you own a small part of every single business on the planet. It's probably not going to go to zero at least. I'm sure you hear about the lack of time too whenever it comes to real estate investing. So what if our listeners want to be exposed to real estate, but they just have so little time to conduct research, regardless of their net worth? How do they enter? What do they do if they want to diversify?
There are other things that are even more hands-off. There are crowdfunding portals. You literally, like in your phone, can invest in a company the same way of buying a stock. It's very, very easy and passive. At that point, you really are nothing more than just a glorified lender to these other real estate investors. Nothing wrong with that, but you're not necessarily going to always achieve a lot of the upside that the owners of the deal are going to get. Same with a syndication. You get a little bit more in a syndicate. When I say syndication, I'm talking about a bunch of people pooling their money together and then giving it to an operator like myself or David, and then they go out and invest in the deal. So there's like the syndication side, and then there's these crowdfunding portals, which you can give money to. There's also like this idea that if you don't have time, first of all, real estate's fun, I think, because it doesn't take much time. In reality, like if you have an extra 30 minutes a week, you could probably buy a real estate. Like it doesn't take a tremendous amount of time to get started, to make an offer, to go online, to look at a deal, to analyze one. I mean, it's all 5-minute tasks. It takes some learning. You might have to read a book or two. But if you have the fire, you're going to figure it out. You're going to make the time. And if not, then there's, like I said, like David said, you could put your money into another person's fund and just say, hey, I trust John, so I'm just going to wire John $50,000 and see how the investment does. And a lot of people choose that route, and they just send money to somebody else as long as they trust them. And the nice thing is you can diversify. So you don't have to invest with one fund or one syndication. You could go and give 10 different investors $50,000 a piece and take $500,000 and dump it into 10 different investments. And some of them might average 10% return on your money every year. Some might average you a 20% return on your money. I know we try to aim for 15%. If we can do a 15% return every year, and that's from the time you, both in terms of the money coming every month and every year, we call that cash flow. That's just profit, kind of like dividends. And then there's the actual, you sell the property again someday and you get a big chunk of that. So that's the money at the end when you sell it. So combining those two things together, we can hit a 15% return. That's a whole lot better than the stock market. So if you're aiming for a bunch of different investors, all trying to get 13, 14, 15%, hopefully on average, you get a better return than you would in the stock market with really no effort other than signing a couple of papers and wiring money.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.